Hey everybody, Brian from quantlabs.net here. Just want to show you a script I'm working on that will measure risk. Namely, this is a good example of the volatile week we've had in the last week here on October 17th, 2014. So what I'm going to do here is I'm going to just run this script and I'm going to break it down. I've got a breakpoint right at the end here before we close out this script. So let me just run it. Basically what it's doing is using basic statistics. So what we're doing here is we are adjusting the date. It's only going back for the last year. What it's doing is, let me show you the, actually I'll just do that later. So we get our date range of last year's end of day data. So what we've got here is we've got over just 248 days or returns calculated. What we're doing is we are going to set, hey, how many days of the last year were positive with positive returns and how many days were negative. So I do a count here. So it's 130 positive and 118 negative. So that's a pretty good calculation on the risk on that particular asset. Of course, we can compare this against, if I was to do this against the stock, S&P 500 or against an index, you can do a comparison to see how this is doing versus a particular asset, namely like a stock or something. But I'm just going to show you the mechanics of this. So again, we get number of days positives, number of days negatives. Then we calculate the frequency of the positives, which is 0.52. and 0.47, which is our negatives. Then we calculate the average of the positives and negatives. So in our case, we are looking at a positive, a mean positive of that and that for negative. And then we can also calculate our mean of the returns, right here, standard deviation. And then what we do is we do a calculation on our standard deviation 1 and 2. We do a range check on that. So 0.94, 97, and so on and so forth. Okay. So we do that range on standard deviation 2 and 3. We also calculate the skewness and kurtosis if you want as well. What we do is we plot that histogram, which I just mentioned here. Where is it? Oh, there we are. This is our normalized histogram of the returns, positive and negative. You can obviously do this or learn this on your own, but I just want to show that this normalized histogram can be created quite easily. This will be part of my reports as well as all the data I'm showing you. Just to do a comparison, like a risk assessment of this particular stock versus, again, you get a typical index, I don't know, S&P 500, maybe something else, who knows. Continuing along, so we've got the end of the graph here. So here we continue along. What we're doing is we're trying to calculate our fixed normal percentages for confidence levels. So standard deviation of 0.682, standard deviation of 2, 0.954, standard deviation number 3, 99.8. And then what we're doing is we can calculate the actual standard deviation within the range of our standard deviation of the low and the upper bound. Calculate the number of trading days for that. Do the same thing for 2 and 3 standard deviations. And then we also do a calculation. So that's actuals, but we can also do the same thing with our normalized. So we use this data here on these fixed normalized percentages on the normal percentage that we have and our size of our array. And then what we can do is we can do a comparison between the two, what they should be and what the normalized data says. That's pretty well it. So as I said, you can use this data, compare it against another index to get a comparison of how that particular stock, could be a future, could be a a currency, whatever you want, against some form of an index to see how it's performing. Just want to show you the mechanics of it. It's pretty powerful stuff, but this was whipped up pretty quick because of the power of MATLAB. Other than that, I'll talk to you later. Hopefully this will help you out later.